The autumn of 1929 erased $30 billion in wealth in a matter of days. A decade of paper prosperity vanished, triggering the longest economic contraction in modern history. Before the fall, American industry was running at maximum capacity. Innovations in assembly line manufacturing drove down costs and flooded the market with consumer goods, from automobiles to household appliances. This chart reveals a structural flaw. The top line shows corporate productivity climbing sharply, while real wages remained flat. To buy products on stagnant incomes, households relied on installment credit. The widening red gap represents the massive, unchecked accumulation of consumer debt. Meanwhile, the agricultural sector was already drowning in loans taken out during the First World War. The entire domestic economy was resting on a foundation of debt. If a sudden shock disrupted personal incomes, millions of citizens would default, and the purchasing cycle would freeze. That shock arrived in late October. After weeks of volatile pricing, panic selling consumed the New York Stock Exchange on Black Thursday, culminating in a massive market collapse 5 days later on Black Tuesday. With a record 16 million shares changing hands, the sheer volume of trades overwhelmed the mechanical ticker tape machines. Running hours behind, the tape left investors completely blind to the actual value of their stocks, accelerating the panic. Leading Wall Street financiers pooled their resources to buy up shares above market value, attempting to project confidence and halt the slide. The momentum of the sell-off swallowed their capital in days. The panic on the trading floor soon bled into the streets. When high-profile institutions like the Bank of the United States failed, terrified depositors rushed to withdraw their funds before the vaults ran dry. In 1930, there was no federal deposit insurance. A closed bank meant a family's life savings were permanently erased. To survive the widespread bank runs, the remaining institutions hoarded cash and froze all new commercial credit. A localized correction in the stock market had metastasized. Without credit, businesses closed their doors, and without trust, the financial system ceased to function. By 1933, the national unemployment rate reached 25%. In major manufacturing hubs, nearly 40% of the workforce was suddenly stripped of all income. Unable to pay rent, evicted families scavenged scrap wood and sheet metal to build makeshift settlements on vacant lots. They sarcastically named these sprawling shantytowns Hoovervilles, assigning the blame directly to the sitting president. With no federal safety net in existence, survival depended entirely on overstressed municipalities and private charities. Millions of adults spent their days waiting in local breadlines for a single meal. Out on the Great Plains, a different kind of collapse was taking shape. Decades of deep plowing had stripped the prairie of its native grasses. When a severe, multi-year drought struck, the topsoil dehydrated into fine powder. High winds lifted millions of tons of this dry earth into the sky. On April 14, 1935, a day recorded as Black Sunday, a wall of dust 1,000 feet high swept across the plains at 60 miles an hour, suffocating livestock and turning day into total darkness. Facing environmental ruin and foreclosure, over 200,000 farmers abandoned their land. Families packed whatever they could tie to their vehicles and migrated westward toward California in a desperate search for agricultural work. The dual collapse of industrial finance and agricultural ecology stripped away the mechanisms of survival, leaving citizens completely exposed to the elements of a failing system. The American liquidity crisis quickly crossed the Atlantic. European nations, heavily reliant on American loans to rebuild after the First World War, suddenly found their credit cut off. As this map illustrates, the U.S. government's attempt to protect domestic industries via the Smoot-Hawley tariff completely backfired. Retaliatory tariffs sprang up globally, choking off international trade routes and shrinking global commerce by more than half. Stripped of export revenue and American capital, Europe's financial institutions buckled. The collapse of Austria's Kreditanstalt triggered a continent-wide banking panic, ultimately forcing Great Britain to abandon the gold standard. The contraction hit Germany especially hard. Dependent on foreign credit to pay war reparations, the Weimar Republic watched its unemployment rate soar past 30%. Desperate citizens, facing starvation and institutional failure, lost faith in democratic governance. This widespread economic misery provided the exact conditions necessary for the rise of political extremism, elevating Adolf Hitler and the Nazi Party to power. A failure of credit regulation on Wall Street had dismantled global trade, plunging the world into a geopolitical crisis that would eventually lead to war. In the United States, voters demanded intervention. The 1932 election handed Franklin D. Roosevelt a mandate to combat the Depression through a massive expansion of federal power known as the New Deal. The centerpiece of this effort was the National Industrial Recovery Act. Through codes of fair competition, the government attempted to directly manage wages, hours, and prices across entire private industries, signaling compliance with this Blue Eagle emblem. This rapid expansion of federal authority faced immediate resistance. In Brooklyn, the Schechter Poultry Corporation challenged the government's right to dictate their local business practices, taking the dispute all the way to the Supreme Court. The justices ruled unanimously against the Roosevelt administration. They struck down the NIRA, declaring that Congress had unconstitutionally delegated its legislative power to the executive branch. Blocked from directly managing industry, Roosevelt pivoted to monetary policy. Through the Gold Reserve Act of 1934, the administration confiscated private gold holdings and devalued the dollar, forcing an expansion of the domestic money supply. The urgency of saving the economy had collided with the strict boundaries of the Constitution, forcing the government to constantly test the legal limits of its own regulatory authority. Devaluing the dollar successfully stimulated GDP growth and stabilized prices, but millions of laborers remained out of work. The New Deal's domestic programs mitigated the suffering, but they did not fully cure the structural unemployment. Full economic absorption required mobilization. Following the entry into World War II in 1941, the United States transitioned into a total war economy, instantly absorbing the surplus labor pool into defense factories and the armed forces. This massive, sustained deficit spending finally overwhelmed the deflationary spiral of the 1930s, replacing industrial stagnation with peak manufacturing output. The crisis left behind a permanently altered financial architecture. The creation of the Federal Deposit Insurance Corporation ensured that a bank failure would never again instantly erase a family's life savings. In a single decade, the strict adherence to passive, laissez-faire capitalism was dismantled. The Great Depression forced the American government to become a guarantor of the economy, a role it retains to this day.